Nancy, if I could. How many times you at a conference and people know you from our podcast? Probably a lot, right?
Tons. Just say, of course.
Yeah, for sure.
When,
They're like, sign my T-shirt, rip open their chest,
right,
sign
exactly.
here.
When we had Vivek Ramaswamy on, I said to him, first before we get into it, are you familiar with mine and Bobby's work? He's going, nope, never heard of you. Like, dude, how hard would it have been for you to just say, oh, sure, yeah, I love you guys. You know what I mean? Like, do you want to be liked or not?
That's why he won't get the presidency.
Bingo, right?
You lost my vote when he did
You
that.
lost my vote. Yeah, no, I never heard of you guys. All right. Let's get to the podcast. Nancy, so introducing you as a founder of Quadratic Capital Management. And the last time we had you on, I remember the conversation was awesome because the way your investment products were just so much different than everyone else's we had talked to. Can you explain to the people what the crux is of your guys' thesis?
Well, we QSIP the rates market, I guess, is a starting point. Like, I kind of thought that it's so foolish to just only have like short vol in fixed income portfolios. So giving, if you think about the ag index, for instance, like a third of it is US mortgages, and homeowners are along the option to prepay inside mortgages. So if you own a financial mortgage, you're short options to homeowners. You guys know, as options pro, any place you're short options, you're short vol. So what we decided to do is just to say, look, let's at least give people a way to be long fixed income volatility and QSIP the market by creating these ETFs, and they're both long vol. It's a pretty good time to be long vol, I think.
That's what I was going to say. Yeah, right.
No, I got one.
Yeah. So I had a question for you. So when you're talking about volatility in the bond market, and I seem like I'm the only one who, terrified wasn't the right word. When I saw that 30-year auction, I think it was the 11th, I was like, shit, nobody wants to buy it at 4.8. They buy it at 4.85. I thought it was a really big deal. Do you think it was a really big deal? And what was it a reflection of?
I mean, I think it's a reflection of people just waking up and saying, like, it doesn't make any sense for, right now we have policy rates. You can put money overnight at the Fed, and get paid more than you can to take long duration risk. It's not normal, right? Normally, when you lend money longer, you get paid more. Or said another way, if you lend money to the US Treasury Department, you should get paid more, and you don't right now. So it's kind of a not normal environment that we're in with this really inverted yield curve. And, it's always tricky to say, how is it going to uninvert? Like, is it going to uninvert because the Fed cuts rates because something bad's happening? Or is it going to uninvert because the rest of the world is going to wake up and be like, yo, we're not going to subsidize your debt and get paid less yield to lend the Treasury money for longer. So it's kind of cool because we don't really care about where interest rates are with the options piece. We just want the spread to widen between rates.
Okay, so one quick question before Bobby, that when you see that your answer that you just gave is embedded in that answer, the world's saying you guys are spending too much goddamn money and there's too much supply that's coming behind this when you have to finance these wars and send these aid packages. Do you think that's a component of this?
I don't think so. I don't think there's really any I don't see any stress or fear right now about.
What if I really want it to be a component of it? Can you give me that or no? I'm just kidding.
Yeah, I mean, there's a lot of things, a lot of reasons to be stressed, but I don't see a lot of stress right now in the market. Like having the yield curve have an upward slope, meaning like the Fed sets a policy rate, but the term premium of interest rate is set by the market. Like, it would be normal to have an upward sloping yield curve. That's not some like tail event. That's not, it could happen because of a tail event, but you don't need a tail event. Like, okay, so this is the difference between the 2-year and the 10-year interest rate. It's looking at the swap market, not the Treasury curve. The swap market's a lot bigger than the Treasury curve, and it's the unfunded market, right? So the swap curve is actually lower than the Treasury curve. So the last was around 45 basis points. And this red line is 0, right? Saying no term premium. Like, the policy rate that the Fed sets is the same as the 10-year. And this is not normal, I guess is my point. Like if you look at the number of times the yield curve inverted, it was in the 80s. It was right before kind of the tech blow up. It was right before the global financial crisis. It was here for a hot second. I've always actually listed during this period, and then it's now. And so this is normally, like you can see the average is, it's normal to get paid 1% more to lend the US Treasury money for 10 years versus 2 years, on average historically. So this is a not normal time. And it doesn't, I think the cool thing, the reason I like the funds so much is we just want the spread to widen, to go higher. Whereas most people in fixed income, right, they have credit risk. So what they want is credit spreads tighter.
When you are saying the spread, you meant
I
credit
mean
spreads,
rate
right?
spreads.
You meant
We trade rate spreads. So what no,
duration?
Interest rate spreads.
Okay. So what to
So
what?
the 2-year to the 10-year interest rate is what eyeball axis is. So we want the
Right.
spread between
Gotcha.
rates to one.
Yeah, that's what I got.
Yeah,
We trade
it's
that
just
all
like
the time. Right.
I
Yeah,
kind
okay,
of
got
break
it.
up the bond market into two risks. There's rate risk and then there's spread risk. And like 99% of people take credit spread risk, whether it's private credit, levered loans, high yield bonds, investment grade, it's all munis, right? That has credit risk. This is a chart of the credit derivative index for the 1-year CDX. It's 17 basis points. This is just because all this money has poured into short duration because it's got no place to go, right? So like the vol curve and credit curves are the same, right? So in periods of risk off, credit curves invert because think about it. If you're a borrower, if you're a corporate, right? Say you're, I don't know, Bed Bath & Beyond, right?
Ford.
You gotta
Sure, yeah,
pay
okay,
back
yeah.
that loan, or you gotta amend and extend your loan. So the credit curves are actually very upward sloping right now, which is because there's no fear at all. There's no fear of war, no fear of everything. This is the 5-year point. So 5-year CDX is 77 basis points. And if you own a bond with credit risk, you want credit spreads tighter. You want this line down, right? And you lose money when credit spreads widen, which happens when equities sell off because it's all corporate risk, right? What we do, we want that line higher. So we want interest rate spreads to widen. So it's just something else. But yeah, there's credit owning short duration is like, if it's treasuries, it's fine. But if it's short duration credit, like where is it going to go? It's 16 basis points. Like there's no premium at all. There's no fear at all in the market. And there's just so much money that's flown into anything that says short duration.
So this may sound like a silly question, but so I remember from my experience when I was in the investment committee of a fund of funds, and we had a specific product designed a specific way, and it was performing over 10 years the exact way it was supposed to perform. And then right when everybody needed it, nobody wanted it. And then after everybody, after the move had already happened that the product was designed for, this is back 2001, then all of a sudden everybody came back and said, hey, can you guys still do what you just did? You said it's obviously a good time to be involved in interest rate volatility. How long do you think this kind of environment can persist? Do you see a low volatility environment for a long stretch in the future? Or do you think at least medium term, this is our future?
Look, I think there are a lot of market pundits out there who are going to speculate that they know what's going to happen in the future. I am not one of those people. I do not know what's going to happen in the future, but I can say if you look back since really 2009, the Treasury market has been manipulated by the Fed, right? We've had the Fed in there, the New York Fed going out there and buying bonds in the QE era, right? The quantitative easing, where the New York Fed is actually going out to the market and buying. Now that's been turned off. They're doing quantitative tightening. Now they're letting the balance sheet roll off very slowly, right? 90 billion a month is nothing when we're talking about a $8 trillion denominator, but still they're not out there buying. So I think it's reasonable to assume that volatility should be higher in interest rates. And then here's the real kicker is that prior to the QE era, it was just normal for mortgage investors to hedge their rate volatility, right? Because homeowners in the United States can prepay their loans whenever they want, right? That's just normal in the US. In other countries, it's not the case, right? In Canada or in the UK, you have penalties and you can't prepay whenever you want, but in the US, you can. And so homeowners are long the option. Owners of financial mortgages are short that option. And so it was just normal for mortgage participants to go out and buy US swaption vol, so interest rate vol. And that was just normal course of business, right? Of course you have to hedge, for a rate environment and prepayments changing, right? Because you're modeling when homeowners are going to prepay, and anytime you're short options, you're short vol. Then with the QE era, a third of the Fed's balance sheet is mortgages, right? So that's just all that hedging. People get lazy, 15 years of, not having your hedge work, people just stop. And so I do think it's normal for mortgage participants. Sometimes it's called negative convexity, where they're hedging that negative convexity. It's normal for mortgage investors to buy rate vol. And now with the Fed stepping out, and look, prepayments are really, really down because interest rates are higher and homeowners are rational. There's a question about what's the Fed going to do, because they've said previously that they don't want to own mortgages on their balance sheet long term, right? We have this huge wealth gap. There are tons of people that, if you're not in the property market, you really can't afford to be right now because prices have moved up so much in real estate, especially since COVID.
So I'm old enough to remember when they were advertising no prepayment penalties. That's actually something that you come in and get our loan because there's no prepayment penalty. And then it just became a normalized situation. You mentioned Fed manipulation. We talked to Luke Groman last week. His podcast is up right now. And he basically said, I'm paraphrasing. I don't even want to say Luke said. What I got from Luke was that the Fed coming in and continuing to do what they do is almost, I'm putting that side by side with prepayments where they don't have to advertise it anymore. It's just what they do. So as we get further and further into this sort of debt spiral that we're in the US, do you think that the Fed is actually starting to want to not manipulate markets, or are they just going to come back in like they always do, accepting that you don't predict these things for a living?
I think they don't want to have an $8 trillion balance sheet, right? And, there was more QE done in the 8 weeks after the start of the US COVID pandemic, so March 2020. In that 8-week period, there was more QE done in 8 weeks than there was in the 9 previous years, right? So they blew up the balance sheet. And now they've been hiking policy rates. We've had one of the most aggressive hiking cycles. Like, think about it. It's about a 12-month period to get policy rates, overnight rates, to 5%. They've been hitting the same thing over and over again, but they're not shrinking their balance sheet, right? Like, go back to Milton Friedman, right? There's too much money. Like, think about how many times do you guys get an email about getting a business loan? I get them all the time. Like, literally, it's like deja vu, right? It's the same bubble, like in 05, 06, 07 in our snail mail, right? In the mailbox, you'd be like, hey, you pre-qualify for a loan. Here's a mortgage. Right now, all the money is in private credit and it's totally got no place to go, right? Allocators are, think private credit's this like magic unicorn, right? Non-correlated. Like, it's the same, whether it's a public company that you're lending money to or a private company that you're lending money to. I don't really get it, right? There's revenue, there's expenses, and fingers crossed, hopefully there's some profitability, but there's way too much money out there still. And I think the Fed's got to be concerned about, hiking policy rates. It's kind of like, it's kind of impotent, right? Because with all this money supply out there, does it really make a difference? Is it really going to slow the economy and slow inflation? Markets think it will, right? Nobody's really worried about inflation, right? That's kind of like, yesterday's news, but I think people should be. And I think the Fed will probably use their balance sheet more as a tool, because they're going to bankrupt our country, right? If they keep hiking rates, like at some point, the Treasury, I've read, Luke has all these great statistics too about how much debt servicing costs are, that it's more than our military, right? It's really, really expensive right now with interest rates where they are, let alone when the yield curve normalizes, which eventually it will, because it's not normal to have long dated rates. Like, think about it. You lend Janet Yellen, here's some money, take my money for longer and pay me less, right? That doesn't make sense.
Right. So earlier you said that credit spreads you were talking about on the short end, and you said, I think you said that corporate, I assume corporate AAA rated credit was only 16 basis points higher than
16
Treasury.
basis points of spread. And it can only go to zero, right? Like, it's not going to go negative. Like, you get paid 16 basis points more for the 1 year CDX.
Why are people lending to them then?
All this money is pouring into short duration. And I want to grab people and be like, what the heck are you doing? Like, and then there's only two types of bond risks, right? There's rate risk and spread risks. And so if it doesn't take a lot of rate risk, not an all government portfolio. All governments, no problem with that. Short duration, all governments like it, right? But if it's short duration and then it has credit in it, a lot of it can be levered derivatives and structured credit, right? Anytime you see those 3-letter acronyms, it's all like structured credit, right? And then or corporate.
Yeah. Well, hold it, but aren't you forgetting?
Yeah, you totally have
risk,
default
though,
risk,
too?
and
You didn't mention that.
Especially a short dated, like, you get paid 16 basis points on the 1 year CDX versus the 5 year at 76. I mean, the 5 year at 76 is still kind of crazy, right? Like, that's very little spread above governments to take credit risk at all, right? Yeah, it's like, but 16 basis
Seems
points,
idiotic.
I want to grab people and be like, like, what are you thinking?
Right. Like, we've been waiting our whole life for 5.05 from a treasury, and you're going to be like, no, I want 5.2.
Yeah, it's crazy.
No, it just makes no sense to me. Yeah, till you just told me that now, because I mostly am in treasury stuff. I rarely even look at that shit, and it just dawned on me as you said it. Thank you for that.
Credit curves are just like ball curves, right? When the shit hits the fan, they invert. Because think about it, if you're a corporate, right, and you borrowed money, if you're Bed Bath and Beyond, you got to pay back your loan or you have to amend and extend it, right? So, or Evergrande, like companies that have short dated loans. Like, even think if you were a corporate treasurer, right? If you're the CFO of some corporate, why the heck would you be borrowing money short term right now with an inverted yield curve and interest rates where they are, right? You'd want to term it out. So it tends to be, I would say sort of the weaker companies too that would be borrowing in this rate environment on the short term.
So you actually answered the question I was going to ask. Why would somebody be doing it? So, and you have a skill at doing that. So the other question,
but then it leaves us looking stupid. Like when they answer our question, like, no shit, I don't know what question.
Believe me, we don't have a hard time looking stupid in this. We don't not have a hard time looking stupid in this show.
No, we can do that on our own. Yeah.
So one of the things I got some pushback from I guess it doesn't matter, but a younger TV anchor when I was doing an interview, when the 10-year got up to about 4.35, somewhere in that range. I was doing an interview, and I mentioned that somewhere in the range of 37% of S&P 500 CFOs and CEOs were not old enough to remember when rates were here this last time. And this particular anchor jumped in and said, "But Bob, they can read."
280 characters only, though.
And I
gotta feel it.
No, and I'm like, I know they can read, and I stupidly brought up the old Mike Tyson quote that everybody has a plan until they get punched in the face. Do you think there's a significant amount of these sort of corporates that can't, in the real scenario, manage this that well?
I think,
or
look, if we take a little bit of perspectives, like the Fed hiking rates is pretty recent, right? And most corporates have termed it out, so they haven't felt a lot of the pressure of higher rates. Same with the U.S. Treasury. Like, we have a third of the Treasury debt coming due in the next year. Like, are they going to freaking feel that? Hell yeah. It's a lot more expensive to issue, whether you're issuing a 30-year piece of paper or a 1-month T-bill. It's expensive now to finance all that interest expense. So I do think there's a lag effect with hiking policy rate. That's a cool thing. Like, we like when the Fed cuts rates, right? That's good. We don't really care whether 10-year yields go higher or 2-year yields go lower, it doesn't really matter. It's a spread trade, right? We want that spread to widen or uninvert or steepen. It's got, or, right now there's negative term premium, meaning like you lend the treasury money, you lend the US dollar in US dollar swap market, you get paid less than shorter dated rates. That's not normal. So there are a lot of different ways to win, whether it's like a risk off environment and the Fed's cutting, or the rest of the world says like, hey, we're not going to be lending. Think about who owns our debt. A third of it is owned approximately by the Fed, right? They're not buying anymore. A third of it is owned by foreigners, with China and Japan being 1 and 2. Are we going to fingers crossed, hope they keep buying? It's like, it's pretty unknown. So going back to your point about rate vol, like I do think rate vol is in a new regime, right? A new regime of, not having the Fed manipulate the markets by doing QE all the time, and also having the rest of the world wake up that, we're one of the only inverted yield curves in the world. These are all Bloomberg codes that are pulling in, it's just an Excel spreadsheet, but it's all linking. This is all Bloomberg data. So I'm pulling in here, not every market, most of the markets where they have these curves are using the inflation protected bond, and not every market has inflation protected bonds. So when it's blank, there just isn't one. Like, the Eurozone, they do it. Not every country has it. But here you can see this is the nominal bond curve. So like in the US, this is the treasury curve, or in Japan, this is the JGB curve. And then here's the swap market, which is the unfunded market, right? With swaps, people, that's what the levered community uses, because you don't actually have to put up cash, right? If you're issuing a bond in US dollar, you can go hedge your exposure in the swap markets. It's a lot bigger than the treasury market in terms of notional size. But you can see here, like, here's the US, right? This line right here. The US swap market is negative 50. Let's just look for a second. Japan, right? Japan, they've been doing yield curve control and QE and all this shit. It's positive 81. Like, that does not make any sense, right? The US has one of the most inverted curves in the world. And I think it's I would expect that this normalizes, right?
Are we less inverted than Chile? Am I reading that right?
It's a great, it's
more inverted rather?
Norway. I guess Norway is more inverted in their swap market by a little bit, but I don't think most people give a shit about Norway.
They have like 8 people who even live there, right? I mean, it's Norway. Sorry,
Sweden
Norwegians,
too. We don't know about the Swedes, but besides some, let's just say Scandi regions, it's pretty whack, right? Like when you compare it to Japan and other countries in the world, it's just normal to have an upward sloping curve, and this is not normal.
Can I a quick question, because I want to get you back to my team about being scared that nobody wants to buy our treasuries. So Luke was talking about how next year in 2024, I believe the number is, if rates stay the way they are and we have to refinance our debt, 1.2 trillion of our government spending will be debt service, compared to 900,000 of the defense budget. When you look at that, now I'm going to ask you to put on your prognosticator hat, because Bobby and I do make predictions. And Bobby, I'm going to ask you the same question too. How is that going to play out? And is the Fed going to come back in and buy bonds so the Treasury can borrow to pay their debt and to try to roll it into even longer duration still? How does this play out, Nancy?
This is why I love
you don't know, that's
so
fine
much,
too.
Right? Like I know I'm the fund manager. I know you'd say, oh, I'm not, but I believe in it, because like it doesn't matter. Like either the Fed's going to cut rates because the Treasury is going to be like, what the hell are you doing? You're bankrupting the country. Or the rest of the world is going to demand at least the same as the Fed's policy rate to lend us money longer term, right? So it doesn't really matter how you get there. It could be the Fed cutting rates. It could be stagflation, right? We could have a period of low growth coupled with sticky inflation, higher for longer. That could totally happen. So I'm not sure exactly how it's going to play out, but I do feel confident that there are not many things in the financial market that you can buy that are trading at valuation levels from below the 80s, right? Like if we just take a big step back, like there's not much out there that is cheap, right? But the US yield curve is cheap. It's still negative, and it's one of the most negative in the world. And it's like, doesn't really matter. Let me just share my screen with you again. It's been inverted for longer and lower than it ever was before in the history of the swap market. Going back, this starts, if you can see on this spreadsheet, this starts in the 80s. And this red line here is 0, right? So the number of times, in our lifetime that the curve's inverted, it hasn't been many. And I think this is why I'm so passionate about it, because I'm like, this is pretty attractive, whether the Fed cuts rates or there's more positive term premium. Either way, I think it's good, right? And you don't really have to know. You don't have to have a crystal ball, right? You can just say, at some point, things are going to be more normal in interest rate markets.
I think they leave rates high. I think, I don't know who said, it was either my Uncle Vito or Maya Angelou that said, when somebody tells you who they are,
That's
believe
random,
them.
by the way.
Like
you say my uncle or Maya Angelou?
Probably my Uncle Vito that said that. But it was Maya.
Do you really have an Uncle Vito, by the way?
Yeah, Uncle Vito, Uncle Lorenzo, Uncle Hugo.
Because I had convinced everybody in high school that I had an Uncle Vito who took care of things.
Yeah.
And but I never really did.
What you said in the playground.
But anyway, go on.
Well, if you would have known my Uncle Vito, you would have. You would have known my Uncle Vito, you would have known an Uncle Vito that took care of things. But that whole line of, when somebody tells you who they are, believe them the first time. I think Jerome Powell and the rest of the Fed squad keep squawking higher for longer. And I believe them, but I think they're going to buy bonds. I think they're going to buy a lot of bonds.
So do I.
So I think they're going to leave rates, and it's kind of like a lawyer's dodge, right? Where they go, I don't see anything happening at this very moment that goes against that. They're just going to go ahead and buy bonds when they think it's appropriate and leave short-term rates higher.
Well, they'll start off by saying, we're just going to reinvest. We're just going to reinvest.
Yeah,
we're not going to let them, before they do anything bigger. And they'll hope that people don't understand what that bullshit means.
Yeah.
Were you asking Nancy a question? I didn't mean to.
It's funny because, and this goes to Nancy, there's a lot of people. Nancy, you met my friend Matt about a year ago. You guys communicated a little bit. And it was one of the things he kept harping on. He's like, I got to open that futures account and just put on that spread trade. I have to. Because the 210s, it has to normalize. It just absolutely has to normalize. And a lot of people don't, just your average person who might watch or listen to the show, don't understand the implications of it staying this way for longer and what that does to the business cycle and the housing market and stuff. So speak to that a little bit if you could.
Yeah,
why it has to normalize.
I actually have a pretty good chart of this. The tricky thing is like doing that in a futures account is hard, right? Because you have to DV01 adjust it. Now, he knows how to do that because he's a professional interest rate guy. But most regular folks, they don't know how to do that, right? You have to adjust the exposures to be DV01 neutral.
In order to put on a 2s versus 10 in the standard traded futures contracts, the ones that have dominated for so long, there's ratios that need to be done and ratios that need to be adjusted to tease out directional bias. That's what Nancy's talking about.
It's an active trade. It's constantly rebalancing. And then it's
an active trade.
Different sizes of contracts and futures. And the thing that you can get really screwed on is, you're using leverage, right? You're borrowing money essentially from the exchange, and there's no really downside, right? Interest rates are not bounded by 0. So what we access in our strategies is this market, the OTC rates market, which is a huge market. And it's much bigger than the treasury market, credit market, equity market. And this is a chart I wanted to show you going back to this is using the swap market started around the 80s. So there isn't swap market data going back this far, but we can use the treasury curve. So this is the swap market kind of more recently and the treasury market. And then these, salmon or pink colors, whatever. What color is this, guys? This pink stuff. I know men are the ones who are colorblind, not women. But I don't know. It's red, orange. Whatever color it is. It's the yield curve tends to steepen during bear markets. It didn't work here. In the 80s, it actually inverted. And then in the 2022 bear market, it inverted. So those are the two periods. But other periods of recession when the yield curve uninverts, it's typically a precursor of a recession. So it's I think a good risk off trade. A lot of people will use kind of the
we've
steepener
talked
as
about
an
that.
equity risk off hedge because it tends to uninvert or steepen going into a recession. But it's tricky because when you're doing it in futures, right, you're using linear derivatives. So you can make $1 and you can also lose $1. So what we do is we use fully funded options to access this market. And so I think it's kind of nice because you can, you'll still lose money. You still lose money when you invert, right? It's not like you're at free lunch,
Define
but
your risk.
you don't always, when it steepens, you can make like huge money. So like Silicon Valley week, the yield curve, that was when people thought, oh, the Fed's going to be cutting rates, right? The Fed's going to come to the rescue of the banking system and not let all these regional banks like Silicon Valley Bank fail, right? If you look at IVOL's performance, I'm not cherry picking, I'm just saying this is an example of the asymmetry. IVOL's up over 14% in a week, right? That boom is the convexity. That's the options. Because with the option, you have a non-linear payoff. So when you're long an option, you can make a lot more than you have at risk because of that asymmetry. Whereas the futures contract, up $1, down $1, right? So you're not going to make as much on the upside and you can lose more because there's no zero, right? It's not like buying a stock or a bond. The yield curve has been inverted more than 365 days. It's the longest period of inversion in the history of financial markets. And, it could go back there, right? Like
in March, when the SVB thing came out, I assume short end rates that went down. Did the curve, when did it put in that negative 108
it
twos versus
steepened
10s?
because the
And did the
market
curve
started to
steepen
price
back
in
towards
that the
zero
Fed
at
was
that
going
time?
to cut. Right now, we don't have cuts priced in. We just have
Pricing
less
cuts.
negative term premium. So it can happen for a lot of different reasons, which is why I kind of like it so much because you don't have to be,
Right.
you don't need a macro crystal ball, right? It can steepen because there's a risk off environment. It can steepen because there's a risk on environment. It doesn't really matter.
You make it sound like it's not making a prediction at all. But if you're saying the curve is going to go back to zero, there is a couple different scenarios that one of those three things could happen. I think instead of us saying like this is the one thing we're going to happen, you're saying these are three or four
Well, I
things
think
that
the
could
cool thing
happen
is it's
to
different
send it back to
regimes, right? So front end
normalization, right?
rates
Would you agree
here
with
when
that
the
or no?
curve steepened in this chunk, this is because the market was like, holy cow, our banking, we're having a Lehman moment. This regional bank is going to bring down, there's a crisis in the bank. So this is March. So the curve steepened here because people were like, holy
Oh,
shit,
that's
right?
March, right?
That's
Equity
the
sold
Yeah.
off,
SVB.
credit spreads widened. People were like, are we in another Lehman type moment? So this was risk off. This right now, like this is not a risk off environment, right? This is more just
Right.
like the market waking up and being like, oh, the Fed might leave rates higher for longer, right? This is all this move has been since the September Fed meeting when long dated bonds duration is sold off. So I guess my point is I like it because you don't really have to take a bet about the regime. It could work in stagflation, right? IVOL could work in stagflation when you had higher volatility in the rates market. You have inflation expectations increasing. You have, the rest of the world, 30% of our debt's owned by foreigners. They say, hey, US, we want more yield to lend you money to finance the fiscal deficit that you have. Right. So it could happen in stagflation. It could happen in equity risk off like March 2020 or Silicon Valley Bank or, war. I don't want to say, I don't know what's going to happen. Obviously, would people run and buy long dated, like some models, right? Models think of the 10-year treasury as risk free. That ain't me. I don't think of anything as risk free, but would people run and buy the 10-year if they're, things escalate?
It's interesting. That also historically is also an equity market signal.
Yeah.
What you pointed out on that, not the last chart, but the one with the salmon colored vertical lines in there. because the equity markets generally don't bottom completely
Yeah.
and start a new cycle higher until the curve has uninverted. And the only time it actually didn't happen, I think, was 94. But prior to that, every time we've inverted, the curve has had to uninvert before equities actually turned and bottom and then turned back up.
And did Nancy say that's generally when the recession begins? So the predictor of the recession is the inversion.
Yeah, it's
but the
usually
recession doesn't generally begin until we go
We
back
actually
above zero. Is
did
that what you said
a
before?
white paper because like
I didn't mean to cut you off.
all
Sorry.
like let's
No, it's
take April to September questions we always are getting. When is a curve going to uninvert? When is it going to happen? That was like, you know, the question du jour all the time, constantly getting it. And, you know, I want to be very factual about things, right? Like I want to, you know, kind of explain to people like, here's the data. I obviously don't know when it's going to uninvert, but let's look at the numbers. I grew up in Florida, as you know, right? And so I have this kind of like unhealthy obsession with sharks.
Mm-hmm.
um, yeah, probably not what you expected me to say, but I made deepest, darkest secrets. But anyway,
that's what I thought the
I
share
made a
button
little.
was for. We'd share
Actually,
our deepest,
did
darkest
like
secrets. Mary, go on.
the math going back on history about the periods of inversion, how long it's been for this, and then of course had to make a shark meme because yes, the megalodon. Yeah, but this is our
awesome.
this is our white
That's
paper, and
Sharknado.
so it
That
has
is
all that
Sharknado.
kind of data in there, plus my little, you know, handmade shark meme. So you know, gotta have fun with things, right? It was yeah, it was
So
like
was our own
a
friend Nancy
queer
Davis on the cover of
it
Forbes?
was like a whiteboard that was translucent. It was really I should have done a better job with my hair. My hair was not looking very good for that picture. So, oh well, thank you. But yeah, they had me write the quadratic equation on a clear, like see-through whiteboard, and then took a photo of me. It's kind of a little artsy.
When is the curve going to uninvert? I'm kidding. When you talk about iVol itself and you created it, what is the actual, like what, how do you explain to the client why they would need it at all times, or even if they would need it at all times?
I mean, I think,
and I know you can't
I think the thing I like to grab people and say is like, look,
explaining it to us.
The vol that you should be worried about is your bond portfolio, because that's like people generally want fixed income to help diversify equity risk, right? If we just take a big step back, like what's the point? And a third of the ag index, which is, you know, the metric, whether you might not own an ag fund, but pretty much all bond managers are benchmarked to the ag, like institutional portfolios. When you go and you look, they all have the Bloomberg ag, and that it used to be the Lehman ag, and before that it was it's an aggregate index.
Say what the ag
and
is real quick,
it's like an
Nancy,
old
so people
index.
understand.
It's really old, and it doesn't have any inflation protected bonds in it, which so here's a picture. The ag index, about a third of the ag has credit exposure, right? So we were just looking at credit spreads. Credit spreads are pretty damn tight, like not the tightest ever, but pretty close to it. Then it has a third of it approximately is mortgages, right? Which are homeowners along the option. If you own a mortgage, a US mortgage, you're short options to homeowners. Whenever you're short options, you're short vol. And then 42% is treasuries, but it's not inflation protected treasuries. It's literally got zero inflation protected treasuries in it. So iVol takes inflation protected treasuries, which is like the core of our portfolio, about, you know, call it 78% right now. Per our prospectus, it's 80% in treasuries and cash. And then we add interest rate options to kind of fix the problems that exist with inflation protected bonds. Are like in name only, right? They're kind of like, you know, another thing I always have to explain to people is what tips do, how they work, what their downsides are. But tips are not perfect. Tips are all long duration, right? So all these bonds, like if you're actually worried about inflation, you should be worried about the duration risk. And people then say, oh, I'll own short dated tips. Well, inflation doesn't have a zero, right? Inflation can go massively negative. If you look in 2008, break evens fell well below zero. And if you own a short duration tip, you might not be taking as much duration, but you're still long duration, right? You just have less duration. It really should be called less long, not short. It's not short anything. It's just less long. And then it only resets with the consumer price index, right? This is like in equity land, nobody's going to go buy, the NASDAQ or the Russell or the Dow Jones and be like, ta-da, I have the US equity market. It's kind of stupid to do that with inflation, especially because even the Fed, they don't use CPI, right? They focus more on the core CPI or the PCE or survey data. Yeah, it's just one index, right? And the problem with
PCE, right.
tips alone is a third of that index is rent, right? It's the owner occupied rent and the shelter component. So we access another measure of inflation expectations outside of CPI.
It's interesting because years ago, when I was at that fund of funds, still, I spent 6 years there. Somebody approached me and said, "You guys want another product? Do you want to represent another product?" And I'm like, "What are they?" He said, "They're principal guaranteed bonds." So I said, "Really?" He goes, "Yeah, principal's guaranteed. They're short duration, blah, blah." I said, "Well, what do you mean principal's guaranteed? Who guarantees them?" He said, "Well, they're guaranteed by Lehman Brothers." Guess what year that was? 2007. I'm like,
They weren't so
all
guaranteed.
investing
that's why it
involves
warmed my
risk.
heart to
It's
hear
just a
Nancy
question.
say, "I
Like
don't think
the trick
anything
is,
is
you
no
just don't want to
risk."
have your
Because
portfolio all have the same risk.
yeah, the one thing I
right?
would
And
tell
that's why
anybody,
owning, if you have a portfolio with a bunch of stocks,
right?
and then you have the ag index, you don't have any inflation protection, like zero. I like to say my favorite line these days is we live in a real world, right? This is not Barbie world, with the movie coming out. I thought it was good. I
No,
enjoyed
did
it. I
you?
went with one of my good
No.
Was it
girlfriends
good?
and
Be honest.
we had a great time. We actually dressed up in pink and I had a pink bow in my hair and she had a pink bow in her hair and she's super badass. She's a commander in the Navy, so it's kind of funny. Yeah.
When that movie came
Yes.
out, I rewatched Rocky 1, 2, and 3. That was my
Just to
protest.
cleanse yourself.
That was my
It's a
protest.
palate cleanser. Can we go over who can invest in your fund? Does it have to be an accredited investor? Is it institutional? Is it retail? Who invests?
So it's a ETF, which is kind of like, it's listed. It's the ticker is not, it's not eyeball, it's eyeball, like interest rate volatility or inflation volatility or implied volatility. I thought it was a great ticker. We have institutional clients for sure, but I do love when I go to some conferences sometime and I'll be walking down the aisle and a lot of like ball managers, like people who are professional, like ball people will be like, "Oh, I own iVol PA." And it always makes me super happy. So we have, anybody can buy it. It's just, if you have a brokerage account, ask your financial advisor, see if it's appropriate for you, read the prospectus, but yeah, it's out there.
Good. Well, thank you so much for coming on, Nancy. It's always like I try to just hold on tight to try to understand what you're saying, and I think I got most of it this time. This will be an episode that I go back and watch actually to try to absorb the parts that I missed. But I thought it was fabulous. Thank you so much.